Hello, good evening, everyone. Thank you for tuning in today. I will be sharing on CFD Trading 101, which is understanding the basic and benefit of CFD. Let me do some self-introduction first. Okay, I'm Daryl and I have been with Phillip for around 2 years now. So if you have been tuning into our past webinar, you probably have seen me or heard me before. So if you do not know me, I'm the night CFD dealer. So if you happen to call in the night, you will probably recognize me by my voice. Hope I'll be able to share with you some of my knowledge today, and I hope you'll be able to learn something and enjoy the webinar. Along the way, if you have any questions, feel free to write your questions in the chat box below. I'll be answering them towards the end, and there will be a Q&A session. Okay, just like every other educational videos or webinar, right, there will be a need for disclaimer. So this is my disclaimer. This presentation today is intended for general circulation only. Everything discussed today are all opinions. Please do your own research before investing. Should you need any kind of advice, kindly consult a financial advisor or contact your TR. So this is the content for today. I'll be sharing on CFD, which also means contract for differences. Also the types of CFD instruments and how people leverage and trade CFD. With that being said, today my webinar will be on the basic and benefits of CFD. So what is investing? Why do people invest? Okay. So when we talk about investing, right, we definitely want to earn some money out of it. So the golden question is, how do we earn money from investing? So investing, right, is primarily from dividends and also capital appreciation. Maybe I can give you a simple example of investing using an apple tree as an example. Okay. Investing is like growing or buying an apple tree. Okay, when I buy this apple tree, right, I invest in this apple tree. So when this tree grow, there will be apple. So I can either eat this apple for survival, or I can sell them in the market to earn some money. So this apple, right, that we get from the tree is like our dividend. Depending on the stock you invest, from time to time, the stock will give us dividend. So after some time, right, I decided that I do not want to continue growing this tree. By then, the tree will be older and probably be producing more apple and worth some money. So I will sell this tree to someone else. By then, the tree will probably be worth more than my initial purchase. So this is the capital appreciation, where you will be able to sell it at a higher price, higher than your capital. So this is why people invest, such that they will be able to grow their money. So when it comes to investing, right, there are two types of market condition. In the stock market, right, there will be two types of movement. The first one being the upwards movement and the second being the downwards movement. So when it's going up, right, we call this bullish. Okay, so when you hear people saying that the market is very bullish, this means that the market is in an upwards trend. However, right, when the market is going down, we call it bearish. So the two types of market condition are the bearish and the bullish. So in a bullish situation, right, when we want to long the stock, it means that we want to buy the stock. And in order for us to profit, right, the stock must go up. So in order to buy the stock, right, we just look at the ask price. Likewise, when we want to sell the stock or short the stock, for us to profit, the stock must go down. So we look at the bid price. So if you have used our platform before, you've probably seen this bid ask pricing shown in the bottom of this slide. To buy, we look at the ask price, which is the green box. To sell, we look at the bid price, which is the red box. Okay, with that being said, what is CFD? CFD, which also means contract for differences. CFD is a derivative product, which means having a value derived from another underlying assets. Okay, It is traded over the counter, traded via a broker-dealer network, which in this case is traded under Phillip. One advantage of CFD is that you'll be able to buy or sell, which means you can profit in both bullish and bearish situation. This is depending on the type of strategy you want to use. When you buy one stock contract, you do not own the underlying assets, but what you're getting, right, is actually a contract. CFD is a contractual agreement between an investor and a CFD broker to exchange the difference in the value of the financial product between the time the contract opens and the time the contract closes. Different countries' equity have different market hours. So if you hold past the opening hours, right, there will be finance charges, which you will find out more later. So what is the difference between stocks and CFD? One key advantage CFD have against stocks is that we have leverage, which means we can use lesser margin to gain exposure, which I will be discussing it more on it later on. Okay, CFD allows you to go long or short, which means you'll be able to profit from both bullish and bearish market. However, for stocks, if you use our platform before, you will be able to short or leverage if you are using a margin account. And you must have a SBL account in order for you to do that. The interest is the same if you are using a margin account to trade. So unlike CFD, you will only need one account and you'll be able to leverage, able to short, and you'll be able to tap into other different asset classes, which is more convenient for traders. However, do note that if you are holding a CFD overnight, right, there will be a financing charge. Okay, so this is just the brief advantages of CFD, which I will be explaining more in depth later on. Okay, so CFD, the number one advantage is that we are be able to long or short. Okay, when we think that the stock will go up, we will buy. And when we think that the stock is going down, right, then we can short the stock. So we are not restricted by any market directions. We can profit from both rising and falling market. Next, we have leverage, which also means that we can use lesser money to own more contracts. Unlike stocks, we gotta pay the full price of the stocks. CFD allows you to tap into multiple asset classes like, for example, forex, indices, equities, commodities. So sometimes, right, traders use CFD for hedge, which is like buying an insurance, okay? In the event of news, especially the bad news, right, your portfolio can be protected. So we can hedge our portfolio against the news. Okay, so using the S&P 500 to explain on how we can trade two directions using CFD, okay? Whenever we think that the market will go up, we can long at the bottom, like shown in the slide, okay? And take profit at the top or whenever we think that this is the highest it can go. However, right, if we anticipate that the market is starting to fall, then we can immediately short the market. And then again, we are not restricted by any market direction. We can profit in both rising and falling market. By now, you should already know that CFD is traded on margin. Using the power of leveraging, right, we are able to take on larger positions using lesser initial deposits. With leverage, we can amplify our gains. However, do note that leverage is a double-edged sword. We can also lose a lot more if the market goes against you. One reason why people use leverage is because we do not have large amount of money to diversify our portfolio or gain exposure. So we tap on CFD to gain more exposure. Okay, let us compare the difference in terms of money. Okay, let's just say that we want to long 100 company ABC at $100 for this counter. Okay, and for this counter, right, the initial margin required is 10%, which also means that the leverage is 10 times. Okay, so for stocks, in order for us to hold 100 at $100, right, you will need 10K. However, using leverage with CFD, right, we only need 1,000. And using this $1,000, right, we will be able to gain exposure of a $10,000 contract value. So how can we amplify our gains or losses? Okay, so for gains, right, if the stock goes up to $150, okay, we will be profiting $50 per share. So for stocks, right, we will be up by $5,000, and that will be a 50% gain. However, for CFD, we will be profiting the same $5,000, but we are actually up 500% because we are only using $1,000, and then we will be able to profit $5,000. Wouldn't it be great to be gaining 500%? Okay. Now let us hear about the bearish side. Okay, when the market goes against you. So for company ABC, right? Okay, it went down by $10. So in this situation, right, we will be losing $10 per share. So for stocks, we will be down by $1,000, which is 10%. However, for CFD, right, we will be down by $1,000, and that is 100%. This is why I said leverage is a double-edged sword, okay? They can amplify your gains and losses. So let me show you how you can see how much is the leverage for each counter, right, if you are using our platform. Okay, using our platform, using Apple as an example, let's just say I want to long 100 Apple at $170. So when you launch the order ticket, you will be able to see the gross contract value, the margin requirement, and the long short financing charge. Over here, we can see that the margin requirement is 10%, which also means that in order for us to hold 100 Apple contracts, we need around 2.2K Singapore dollars of worth of margin, okay, to purchase the contract that worth around $17,000. So from this ticket, right, you will be able to see the long short financing charges. Okay, do note that different counters have different margin requirement and financing charges. Okay, do make sure you check before placing an order. These are the different types of CFD instruments. We have equity, where we offer CFD and CFD DMA. Okay, we also have commodities, which are mainly oil, gold, silver. And indices, we have S&P 500, US Tech, Wall Street Index, and many more. Okay, so for our indices, right, we actually have mini contracts also, which I will discuss more on them later on. Okay, and we also have Forex. So for our equity CFD, we have access to 8 different global stock exchange, and these 8 different and these are the 8 different stocks exchange like you see in the slide. Do note that, right, each country have its own operating hours, and when the operating hours is over, right, you will not be able to trade. You will not be able to buy or sell. You can find out more in our website. So if you use our platform before, okay, or you are currently still using our platform, okay, when you search on the counter DBS, Singtel, SIA, you'll probably seen this. Okay, the blue one, the blue logo is actually the EQ, which is named the EQ, is actually the equities, which is your stocks. Okay, the green one is CFD, which is the derivative of the stocks. However, the darker green CFD DMA, these are the DMA. Do note that DMA is only for Singapore counters. So equity CFD, these are cash settlement, and it mirrors the price movement of the stocks. From this photo, you can see that there is no additional spread. Okay, you can see that for DBS, the bid-ask price for the stocks, CFD and DMA, all have the similar pricing. Okay, there is no additional there's no additional spread, and all 3 of them have the same pricing. Like I said before, CFD is a derivative product. Okay, when you search for SGX counter, you may see CFD DMA. DMA means direct market access. and is only applicable for SGX counters. The order will be fulfilled. The orders will be fulfilled on the actual exchange and will participate in the exchange order book, which works very similar to stocks. Okay, we will send the order to the exchange. Okay, do note that DMA is based on the last done price, not the bid ask price. At this point, we'll be thinking that what? We'll be thinking that DMA is better since it provides the transparency and we'll be able to monitor via the exchange. Yes, DMA is better because it gives you a lot of transparency. However, right, we have to pay the premium for this transparency, which is the higher commission rate. Do note that if you are trading CFD DMA, right, in order to locate them, you need to click on the CFD DMA, like the photo shown below. So this is the summary version, the summarized version of how CFD and DMA works, okay? Whereas for DMA, right, we will route your order to the exchange and execution is done on the exchange, which is traded on market liquidity and the order book of the exchange, which give the investor full transparency. And this will be reflected on the exchange, just like stocks lah, okay? Therefore, you will pay more commission, you'll pay more commission for giving you the transparency. However, for CFD, you will be enjoying lower commission rate, okay? The order may or may not reflect on the system. Your order field will be based on your bid-ask pricing, okay? So if you want to know more about this, you can read up on our website. So how can we calculate the profit? Okay, assuming, right, we will long 10K shares of stock A at $2. Since we are in a long position, when we want, we are in a long position, right, we want the stock to go up so that we can profit from it. So if it goes up to $3, we'll be profiting $10,000. However, if the stock goes down to $1, we'll be losing $10,000. Basically, the difference between the price entered and exited multiplied by the quantity. Likewise, if we are in a short position, in order for us to profit, the stock must go down. Using the same example, okay, when it goes down to $1, we'll be profiting $10,000. And when it goes up to $3, we'll be losing $10,000. Literally the opposite from long position. So what is commodities? Do you know that commodities, right, are actually part of our daily everyday life? Okay, they are actually the raw materials that we use in our daily life. To help you better understand the meaning of commodities, let us look into this girl in the picture. So for a start, the clothes. So clothes are usually made up of cotton, and cotton is a commodities. So how can this girl get the clothes? She'll probably buy it maybe from online stores. Okay, so the online stores like Taobao, Shopee, okay, all these, right, requires delivery, which also means oil. So oil is needed for the delivery to happen, and oil is a commodities. So what is she holding right now? Okay, she's holding a cup of coffee. Okay, coffee is also another commodities. Okay, so girl being girl, she like to dress up. Okay, so when she dress up, she'll tend to buy those jewelry. Okay, so jewelry like gold, silver, and gold and silver, right, are actually also a commodities. Okay, when she goes to shopping, okay, she will either drive or take a public transport, and this transportation, right, is actually operated by oil, which is also a commodities. So in short, commodities are categorized into 3 different sectors, okay? Metal, energy, agriculture. Metal is like our gold and silver. Energy is like our oil and gas. Agriculture are the crops and livestock that have been raised and harvested to provide food. So in our platform, we do allow you to trade on commodities, and the frequently traded commodities are like gold, silver, oil, and there is no expiry to it. Okay, the margin are as low as 20%. And we also provide the mini contracts. So if you remember earlier on, I shared on how you'll be able to see on the margin required. Okay, so we can use this method to find out the difference between the USD1 and USD100. For USD1, the value per point is $1. So if let's say you are in a long position, you're in a long position for gold USD1, okay, and it goes up to $10, and you will be profiting $10. So unlike the USD 100, right, the value per point is $100. So if it goes up to $10, it goes up by $10, then you will be profiting $1,000. So assuming we want to long go at $2,000, we can see that the contract difference between both is different. One is 2K and the 100 the 100 is 200K. So if we were to do some math, right, if we were to divide the USD 100 by 100, we will get the same as gold USD 1. So the good thing about the USD 1 is that it requires lesser margin, okay, and traders who wish to gain exposure but have lesser capital can actually establish a position in the mini contract. Okay, so this is the meaning of mini contract. So what is index? Okay, this is the method to track the performance of a group assets, or rather a method to measure the performance of a basket of securities. Let's use STI, okay, which is Straits Time Index, as an example. STI is a market capitalization weighted index that tracks the performance of the top 30 companies listed on SGX. There are 600 over listed companies in SGX, but STI only tracks the top 30 companies. All these 30 companies, right, roll up into one easy to read average price. If you hear people saying that the market is up, highly likely, right, they are referring to STI is up, not because STI is the market, but the index is a representative chunk of the market. Because they have the largest and most influential company, or rather the big cap companies in Singapore. So the big cap companies are likely to be more stable and more established in Singapore. As long as you come Singapore before or stay in Singapore long enough, okay, you'll probably heard of those 30 companies inside STI. If I were to name a few companies, they are like DBS, OCBC, UOB, our big 3 local banks. Let's say you see STI doing well, you know that Singapore economy is likely to do well. However, do note that, right, if you see the bigger caps company not doing so well, then the chances of the smaller caps company to outperform is slimmer because they are more volatile. So in our platform, okay, these are the indices that we offer. So these are the ones that we are seeing right now, right, are the commonly traded ones. Okay, you can view more in our website. Okay, we have many more indices, and we do have a mini contract for some of them. So same as the gold example, for this SP 500 contract, we do have the USD1 and USD5. So USD1 is value per point is $1, and USD5 is value per index point is $5. Then again, the purpose of having a smaller contract like USD1 is for traders who wish to diversify their portfolio or gain exposure but have lesser capital. So they can consider trading the USD1. Okay, do note that for our contracts, okay, it tracks the performance of the cash index and its dividend adjustment. And the price difference and the price may differ from the cash index. Okay, different indices have different leverages. Okay, so we offer up to 20 times leverage. So if you have seen our website before, you've probably seen this. Okay, so how do you read it? Okay, using STI as an example, okay, we can see that the value per point is $5. Essentially, what is trying to say that, right, is value per point is $5. If you long an STI and STI goes up by $1, you'll be profiting $5. Okay, the target spread is 3.6, which can be referred to the bottom portion. Okay, assuming that STI is currently at $3,000, then the bid is 2998.2, and the ask will be 3001.8. So if you add the difference, right, it will be 3.6. So that's the meaning of target spread. However, I would like to draw your attention to the target spread. Okay, in the event of volatile market condition, right, the target spread may increase. Next, we have our forex. Okay, when we buy or sell trades, we are referring to the base currency, and opposite transaction take place in the term currency. And for this example, pound dollar, okay, pound is the base currency and the dollar is the term currency. So for example, if we are buying the pound dollar, okay, we're actually buying pound and selling the dollar. So what we want, right, is actually the pound to strengthen and the US dollar to actually weaken. Let me show you an example. Okay, this is how we can understand the codes. Okay, assuming that pound dollar is 1.3. Okay, this means that 1 pound, right, can be exchanged to 1.3 USD. However, using another example, okay, if the pound dollar is 1.45, this means that 1 pound can be exchanged for 1.45 USD. So based on this quotation, right, the profit and loss will be reflected in the term currency. So when you hold a forex, a FX CFD position overnight, okay, so 5 a.m. for the daylight saving and 6 a.m. for the non-daylight saving, okay, the position will gain or lose the swap points. The gain or loss is due to the interest rate differential between the currency bought or sold. Interest is earned on the currency bought, while interest is paid on the currency sold. The swap point gains or loss will be credited or debited from your CFD account as a swap point adjustment. So based on our platform, we are able to access to more than 30 major global forex pair, and it tracks the underlying of the spot forex, and the margin is as low as 5%, which is 20 times leverage, and the minimum contract size is 10,000 of the base currency. Okay, so moving on to the commission. Okay, commission is only applicable during the opening and closing of CFD positions. Okay, when we enter a position, we will be charged commission, and when we close a position, right, we will also be charged commission. Okay, commission for equity CFD trades are charged based on the total contract value of the CFD. Do note that different country counters have different commission fees. Do check our website to know more on a particular counter's commission. Okay, so equity CFD, right, they are done within the same day for the same counter. Okay, they will be charged based on an aggregated basis, which means that the collective commission is charged against the total value of the day transaction instead of separating the commission for each transaction carried out. So for commodities and indices, right, they are charged based on per site, per contract basis. Okay, so and the commission, right, is not applicable for forex CFD trades. Based on the past few webinars, right, quite a number of people ask me on the commission, and these can be found in our website. Okay, so maybe I can share with you how to read this in our website lah, how to count it. Okay, so the top picture, right, is based on US equities CFD. Okay, the total commission, right, when you will need to pay, right, per entry is 0.18 of the total contract value. However, right, if your total commission is under $15 USD, okay, then we will charge you $15. So assuming, right, your total commission for that trade, that particular trade is $12. Since $12 is under $15, so we will charge you $15. However, if the commission for that trade is $16, then we will stick to $16. So for indices, right, like the Wall Street Index is quite simple. Okay, per side is $2, meaning you enter 4 means you pay $8. Okay, do note that different countries have different commission charge. Also, different indices have different charging rates also. Okay, so do look up in our website, okay, to know more on the commission rates. Now let's dive deeper into the financing charges. Okay, when you hold past a CFD position overnight, right, okay, you will be subjected to the overnight financing charges, and this is accrued on a daily basis and will only be realized upon a contract rollover or a liquidation of the CFD positions. So one commonly asked questions are, if I were to open and close within the same trade day, do I have to pay the financing fee? Do I have to pay the financing charges? Remember, I said that when we hold past overnight, right, then we will be subjected to the financing charges. Okay, overnight doesn't mean our 12 a.m. Okay, it means hold after the market closes. So when we open and we close within the same trade day, right, there will not be any financing charges. The only charges, these will only be charged, right, okay, when you hold past when you hold after the market closes. So for example, using the US market as an example, if let's say we were to open a position at 10 p.m., right, and at 1 a.m., right, we decided that we do not want to have this position anymore, we want to close it, then there will not be any financing charge for this situation. So this is how you calculate the financing charge, and this is the formula for financing charge. Okay, so market value of the closing price multiplied by rate divided by 365. So why do we divide by 365? Because the long short financing charge is based on per annum. So it's not fair for you if you, let's say you hold a week, then we charge you per annum. So to be fair, we actually charge based on per day and how many days you hold. Okay, so the orange box is where you can find your market value. Okay, do note that we must use the closing price of the market value. Okay, the market value, the closing price of the market value for each day. Okay, and the green box is where you can find your financing charges. So finance charge, right, is charged on a daily basis of the closing price. So assuming, right, we want to long one CFD and close it on the 3rd day. Okay, so day 1, right, it closes at $1,000. Day 2, it closes at 1.2. Okay, and day 3, you liquidate it. Okay, you do not need to add the financing charge for day 3 as you did not hold past overnight. So this is the calculation of how you calculate your total financing charge. So moving on, how can we use CFD? Actually, right, there are many ways to trade CFD. So depending on your strategy, your goal, and what you want to achieve at the end of the day. Okay, some people buy, sell, and hold. Some people use scalping strategy. Some people use their own self-developed trading strategy. So the first strategy, right, is pretty much like the apple tree example I gave earlier on. Okay, when you buy or sell and hold. The reason for doing so, right, is because it costs, the cost is actually lesser. Okay, the capital that we need to put up front, right, is the capital that we put up front, right, is actually lesser because we have leverage. Okay, and we will be able to attain a higher exposure and a more well-diversified portfolio. Or we plan to get dividend or capital appreciation, just like the apple tree example I gave earlier on. Okay, for us to buy and hold, right, is because we believe that the counter will do well. And for us to sell and hold, right, is because we believe that the counter will underperform. So scalping is the next method and is mainly for day trading. So what these scalpers will do, right, is they will monitor the charts, and when there is a given opportunity, right, they will close the position and earning off small price changes. So for example, let's say we enter a stock at 41.5. So 5 minutes later, right, the stock went up to 41.55. Scalpers will take profit and earn that 0.05 per share, and they will do it all over again, slowly stacking their profits. So in order to be a scalper, you must be really good at technical analysis. So some traders have their own have developed their own unique strategies, and it is based on your type of strategies. So it may be a mixture of indicator, okay? So what they do is they will monitor the stock closely and looking into indicators like, for example, candlestick patterns, okay? So candlestick patterns, when we talk about candlestick patterns, the type of patterns is like maybe head and shoulder, maybe cup and handle, okay? Or some people uses the moving average and things like support and resistance to help them make decision when it comes to trading, okay? So if you were to Google some technical analysis, right, you will see some charts that are very complicated and that have a lot of different indicators. So personally, right, I use a mixture of a few indicators, not just candlesticks, but also moving averages, support and resistance before I decide if I want to proceed with this trade. Okay. Then again, right, all these different indicators, right, are based on your own strategy and your own liking. Okay. So if you must know what is best for yourself, lah. Okay. And ultimately for hedging. So at the end of the day, like I said before, whatever is most suitable for you and what is the best method for yourself and how you can earn money better. So hedging, right, is a strategy used by some people. Okay, hedging allows you to hedge against negative events. For example, earning report. So if you're actively trading today, okay, you would probably know that during the earning report day, right, there will be an increase in the volume of the stock. Okay. Usually when the earning is really, really good, the stock will be very bullish. Okay. However, if the earning is very bad, right, investors will start losing their trust in the company and start dumping it. Okay. Apart from earning report, there's also news like COVID. If you remember, sometime in March 2020, there was a huge drop in prices, or even events like war. So all these events, right, will actually create a lot of fears in the market. Okay. So hedging is like an insurance. So it protects you against unforeseen circumstances. Okay. So if the market goes against you, you do not need to worry because you are already hedged against it. Sometimes you may even be able to profit out of it. Okay. Hedging can be done by establishing opposite positions. Okay. So two types of instruments can be used here, or rather three types of instruments can be used here. So firstly is the equities or world indices or inverse ETF. Okay. When we hedge fully, right, it means that we establish an opposite position for the same counter, same quantity. If we hedge partially means we establish opposite positions in correlated instruments like STI. Okay, indices are a good hedge against portfolio of index-linked stocks. Alternatively, you can hedge with an inverse ETF. Not necessarily you only hedge by taking on opposite directions. You can also hedge your portfolio by buying inverse ETF, such that when the price are falling, the inverse ETF will go up. So an example of an inverse ETF is like SQQQ. Okay, where it tracks the Nasdaq 100, which is heavily weighted towards the technology and telecommunication side, such that when Nasdaq 100 goes down in direction, they will go up in direction. So they have an inverse relationship. So this is based on a fully hedged portfolio, okay? Assuming you already have a 1,000 long at $23 in your stock account, and for whatever reason, you do not want to close your position, okay? And you anticipate that something bad is actually happening, and we decided to hedge fully. So when we hedge fully, we establish opposite positions for the same counter, same quantity. So if the market goes against you, right, you do not need to worry because you're already hedged. For example, when the stock goes to $21, right, then our stock side will be negative $2,000. But for our CFD hedge, right, will be positive $2,000. So if you were to net it off, right, you're okay because it's zero profit and loss. Okay, not necessarily that we need to have a position before we can hedge, or rather hedge against negative news. We can also hedge against inflation. Okay, let's use oil CFD as an example. So in this example, right, you want to hedge against inflation, or rather you anticipate that oil prices will continue to increase. So if oil prices increase, right, means your day-to-day expenses will increase, and you do not want to be affected by the oil prices. So what you can do, right, is you can long some crude oil CFD, as you expect the oil prices to increase, such that, right, if the oil prices actually go up, right, you can get a paid off and you probably get some gains, okay? And these gains that you get, right, can offset your petrol prices. However, if the price of oil go lower, it's okay because you also won't be affected that much since you'll be able to buy oil at a cheaper rate now. So whatever the oil prices goes, right, you do not need to worry of the oil prices. Okay, so these are my own personal take on investing, and I hope that this will be good for us to learn. Okay, so all these, right, are all based on my own personal journey and um my own personal journey lah. Okay, so before entering a trade, right, you must always have a stop loss. Okay, a stop loss is an order, right, that automatically cut your position once the trade hits a certain predetermined criteria. Okay, and it's very important, right, to place a stop loss such that when the market goes against you, right, you do not lose so much. I have seen many investors, okay, they forget to place the stop loss and then they just go to sleep. Okay, and the very next morning, right, when they wake up, right, they lose quite a bit of money. Okay, so stop loss, right, is very important. Okay, always place a stop loss before entering a trade. Next, we have the position size being too big. Okay, when the counter move a bit, right, your account increases by a significant amount, such that, right, okay, the traders cannot focus in their job, cannot sleep at night, even when they are driving, right, okay, they'll look at the counter. So if such situation is actually happening for you, right, then you shouldn't invest such a big sum. Okay, because always remember, right, do not invest more than what you can lose. Okay, so the next one, right, is emotions. Okay, some investors, right, get too emotional. Okay, when they'll start to feel FOMO, the fear of missing out lah. So for example, my friend say that, hey, this stock very good, must buy. So you never research, you just go and buy because you follow your friend mah. Okay, or maybe wow, today this stock goes up by 10%, then I think I should buy. So then when you buy, right, the market goes against you, and then you'll be stuck in that position. So all these, right, are FOMOs lah. So don't FOMO. Okay, there are a lot more opportunities out there. So even if you miss one, right, there's gonna be another one out there. So don't get too emotional lah. Okay, and the next one will be greed. Okay, so like for example, your strategy already tell you that you already hit your take profit level already. Okay, it's time to take the money and go off already. Go on, move on to a next opportunity. However, right, you refuse to take the profit. So you just continue buying and buying and buying and buying and buying. So one day, right, the market goes against you. Then you lose out all your profit that you gained so far. Okay, so don't get too emotional. And when the strategy tell you that you hit your target area, right? Then you need to go already. You don't get too invested in it lah. Okay. So the most moving on to the most dangerous point, okay, over trading. So over trading, as in you just keep trading to a point, right? You just keep trading, and it's like gambling already. So you just tikam buy or sell. Okay, there are some situations, right, where investors get, I would say that they lose too much money already, or rather having a very bad trading day. So what they do, right, is they start to revenge trade. So when you gotten your stop loss already, okay, then never mind, he will just buy in again. Then gotten another stop loss, never mind, he buy in again, which becomes like gambling. Okay, when you lose your first stop loss, never mind, you double up for your second trade. So when your second trade also lose, right, you will double up again. So you will just keep doubling up, right, hoping to gain the money back. But when you're actually facing such a problem, right, or rather, when you're starting to feel that trading is like gambling, right, then it's good that you take a break. Okay, because we always remember that it's good to take a break if you've gotten some stop loss for the day. Okay, because there are a lot of opportunity out there, and do not need to worry about just having 1 or 2 bad days. And lastly, like I said before, okay, leverage is a double-edged sword. Okay, you can multiply your money very quickly, but when the market goes against you, right, you may potentially lose some of your capital. So only invest in what you are comfortable losing. Okay, so for our existing customers, you can create a CFD account by clicking on the account management, CFD, and online account opening. So for new customers, right, you may create an account via poems.com.sg and follow the steps. Alternatively, you can call your TR or walk into our Phillip Investor Center. We have quite a few locations lah, so you can check in our website. Okay, so these are our outlets lah. So you can find them in our website. So I'll give you some time. You can scan on this link to create an account with us. Okay, so you may fund your CFD account, right, via internal transfer. Okay, so what you can do is account management, stock, online form, withdrawal form, enter the amount of money and transfer the amount of money and for the purpose. Okay, alternatively, you can use Pay Now Transfer, where you can watch the tutorial. Okay, for direct funding into CFD account, right, kindly add the CFD at the back. You can watch the tutorial to know how you can add the CFD at the back. Okay, so before we go into the Q&A session, right, okay, you already know that we have recently launched our MT5. And the good thing is that we are having a promotion, right? If you open a new account with MT5, okay, this is our welcome bundle promotion that we are currently having. Okay, you can get an airport trading credit and Grab vouchers when you open an account with us and trade with us. You can learn more about this promotion by scanning the QR code. Okay, and there are different tiers and different reward scheme for each tier. Okay, you will only be entitled to one of each tier's reward based on your initial funding during the promotion period. Okay, there there is a 90 days lock-in period for the initial funding. So for the first tier, right, if you deposit $1,500 and do a total of 5 buy or sell trades, okay, you can get $50 CFD trading credits. And the second tier, if you were to deposit $5,000 and do 10 buy or sell trades, you can get 250 trading credits, CFD trading credits, and $50 Grab gifts. However, right, if you were to deposit $30,000 and did a total of 50 buy or sell trades, right, you will receive 500 CFD trading credits and an airport with worth around $760 in total. Okay, so this is the Q&A time. Okay, do you all have any question to ask me? Okay, while I'm looking through some of the questions, right? Okay, maybe you all can scan the promotion. Okay, if you all want to find out more about the promotion, or you want to create a new account with us today, then you can scan the QR code. I left the QR code on the left hand side and the right hand side already. So give me some time. Okay, so someone asked, if we hedge fully, right, how to make profits? Okay, so for hedging fully, right, okay, not necessarily that you need to make profits, okay, because the end goal, right, is to make sure that if the market goes against you, right, then you're in a break-even zone, okay. So I believe I answered the question for if we hedge fully, how to make profits. Okay. Stock prices live. So someone also asked, are all stock prices live? Yes, it's live if you subscribe to our live prices. So to bring back to the live prices, right? Okay. So other markets like for example US, Hong Kong, okay, is delayed by default one. Okay. And for SG index and FX are all like. And let me see if there's any more questions. Hi Daryl, due to work change. Is there any more questions? Let me see. So someone actually asked, so for the promotion, right, that the mentioned earlier on, okay, can I get more than 2 tiers? Okay, so for the promotion, right, okay, that I mentioned earlier on, okay, you will only be entitled to one of the tier, okay. So it's reward based on your initial funding during the promotion period. Okay, let's say you get tier 1 already, you get tier 1, okay, and you will not be entitled to tier 2. Okay, do note that there is a lock-in period for 90 days. Okay, is there any more questions? If not, I think I will end the webinar here. Okay, I don't see any more questions. Okay, so if you all have any questions that you wish to know more and you do not want to ask today, okay, it's okay, because you can always call our dealing desk, okay, and we will assist you more on that. Okay, so if let's say you want to read up more on our website, right, then you can have more information over here. You can go view our website at um, at the website at above the slide, okay, www.phillipcfd.com, and you can read our info sheet, right, to find out more details about it. Or alternatively, you can call in our dealing desk. Okay, thank you so much for attending today, and I look forward to see you on the next one.